It has been a strong earnings season so far with plenty of beats and revisions higher. But our feature guest today says that strength may be highlighting a potential risk to the markets. Joining us now to discuss is Jeff Evans from TD Asset Management. Jeff, great to have you back on the show.
Great to be here.
Let's start with a surprising strength that we have seen. No shortage of things to worry about, yet corporate earnings are strong. What's going on?
Well, so if I had to describe this quarter and the earnings season, we're not done yet, but obviously fair ways through. I describe it as almost truly exceptional how strong this quarter has been. And what makes it even more impressive to me is not just the numbers that we're seeing out of companies this quarter, it's also that it is on what was already a very, very high bar coming into the quarter. If you kind of look at what's been happening with earnings on the S&P 500, we've had 2 years of double-digit earnings growth in 24 and 25, growing by between 10 and 12% each year. A normal year is 5 to 7. So this has already been pretty elevated growth. The sell side's kind of run with that, extrapolated the trend, and in fact even expanded on that further. If you look at growth from 25 to 28, consensus at the start of the year was expecting about 15% growth per year. As of this morning, it's up to about 17 to 18%. So just phenomenal numbers that are triple, almost now even quadruple the long-term averages. So we came into earnings with very high expectations, and then companies are just blowing through those numbers. We're seeing some pretty impressive surprises. In a typical quarter, 75% of companies would beat. We're seeing 85% as of this morning. That is, if you rank it on all of the quarters over the last 25 years, easily in the top 5 to 7 quarters. Very, very strong earnings beats across the board. Of course, the problem is companies are very good at managing the sell side. You can always find a little expense to shave off or move some things from one quarter to the next. So seeing a small beat on its own is nice on the earnings side, but it's more important if you can also see revenue growth. It's a lot harder for companies to fake that or accelerate it. So we like to look at earnings and revenue growth and who's surprising on both. That number, again, off the charts. 40% of companies have been able to beat on both metrics this quarter. There's really only one quarter in the last 25 that have seen numbers that high. And it's again not tied to just one company. It's not the Mag 7 or tech stocks that are driving this. We're increasingly seeing it across, if you split the S&P on market cap, if you go into mid cap, small cap, we're starting to see this earnings strength broaden out. Surprises not everybody, but certainly in much more places than we saw a few years ago. And then what that's translating to is the sell side is having to play catch up. So we're seeing earnings revisions coming up, 13% year to date. We've seen earnings revisions plus 6% just this quarter so far. Normally at this time of the year, you'd actually start to see, things usually start optimistic and get revised down through the year. We're seeing them start optimistic and becoming even stronger. So I think when you kind of take a step back and think about it, it's been a pretty impressive quarter overall.
One of the reasons why when we do this kind of work, we pay such careful attention to economic growth and the fear of stagflation or recession is because, as the economy grows, we expect earnings to grow. Let's start talking about the risk. You're taking a look at a situation, I think we have a chart we can show the audience too, where, we've had the strong earnings growth, but GDP growth not keeping up.
Well, that's it. Or there's different ways of looking at it. GDP growth has actually been pretty healthy over the last couple of years, but somehow companies have been managed to outgrow that. If you just think about it, GDP is everything the economy produces. That's also effectively income, so the entire income of the economy. And then, what it should be is, there's people like you and me that go to work. We get wages. That's part of that GDP. And then there's companies and corporate profits. That should be another subset. And the thing is, over time, as GDP is growing, you'd expect companies to participate in the same rate. So profit growth and earnings growth should be linked over time. You shouldn't see extended periods of time where one outgrows the other. And that's what you see historically from this chart starts from 89, I think. But if you go back to the 50s, all the way up until 2016, corporate profits kind of wiggle around GDP, but they stay very linked to each other. And then clearly in the last 10 years, we've had a complete disconnect with corporate profit growth accelerating. Some of that is companies having the upper hand over labor, being able to export to China, to Mexico, to India. That's part of the story, is capturing some of the share that labor used to have. And at some point in time, the question is, do you start seeing people fight back? Do you see the higher minimum wage? We saw a little bit of that pre-COVID. Do you see more of that picking up? Do you start seeing corporate taxes being raised? I don't think you're going to see that in this administration, but it's notable that we have a progressive income tax system for people. We don't have that for companies. Do you start seeing different tax rates on mega cap, US tech, or other companies like that at some point down the road? So that is one potential consideration given how far earnings have decoupled from GDP. but it's also that U.S. companies are very international. 50% plus of mega cap earnings come from outside of the U.S. And what's effectively happening here is U.S. companies are taking share from what used to be domestic companies, taking what would have been captured by a Canadian company or European company. It's just coming right back into U.S. profit growth. And so the other question is, do you start seeing different countries fight back? Do you start seeing more digital service taxes? Canada tried it, didn't work out so well. Maybe that comes back on the table in a couple of years' time. You're starting to see maybe more concern on tariffs from other countries to try to recapture some of this in different ways. We're not really seeing any rumblings of that now, but given the disconnect, profits are double what they should be in the U.S. relative to U.S. GDP. You've got to expect at some point there's some policy changes. That's a long-term concern. We're not seeing that today, but I imagine if this disconnect stays in place longer, you're going to see more and more push to try to correct that gap and make sure things are redistributed more efficiently.
In terms of what's happening in this market right now, I can think of like so many interviews I've had over the year where someone's either a momentum investor or a growth investor, and they pit the two against each other. They're both working right now. Is that a little strange?
It's a little bit unusual. You're seeing strength from value stocks and momentum stocks all at the same time. If you think about what these companies are, a value stock is usually something that's underperformed for a period of time, multiple compresses and gets cheap, people aren't that interested in it, so the share price is kind of weak or falling. Momentum stocks are, everybody's scrambling, trying to chase, get on top of these things. So the share price is usually going straight up. And so it's very unusual to see both strategies delivering strong returns at the same time. Part of that is there was just so much focus on growth stocks in the Mag 7 for so long. Everything else kind of got forgotten about to the point where it was almost too cheap to ignore. You're seeing more and more M&A activity, more and more deals, certainly in the real estate and infrastructure space. A lot of these major private companies coming in, doing M&A to capture some of those spreads. But just investors in general have also woken up to this. You're seeing value come back in a very significant way. Value investors tend to be pretty patient. They'll buy these stocks. They'll sit on them for years if they have to recover. And then what's starting to happen now is there is enough strength out of value stocks that momentum investors are starting to pick up on this, that there is actually a recovery in share price. People are picking it up on their trend models or their price momentum models, and those momentum investors are now coming into the market and chasing these stocks. That's very interesting because it's that incremental investor that can drive multiples on value stocks to fairly high levels. And that's maybe the concern today is, 5 years ago, a value stock traded at 8 times earnings. Today it trades at 12. That still sounds cheap, but for a value stock, 12 times earnings is pretty expensive. And the concern that we would have is if that momentum slows down, value investors are patient, momentum investors not so much. And so I think there's potentially a risk here of investors that are focused on it's not just value, but also dividend and income stocks. We're starting to see dividend yields compressed to some pretty low levels relative to history. Canadian banks is a great example. Yields back down to basically record lows, PE multiples at record highs. And so I think it needs is for investors to spend a little bit more time making sure that what they own, do a little scenario analysis. Is this something that can survive in a downturn? And if momentum investors walk away, is there still a solid business, and are you paying the right multiple for it?